Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. You can also go to TomWilsonProperties.com for a lot of education information for investors in real estate, including commercial products and syndications. And we have all of our podcasts there. This is our 5th year of broadcasting. And we have many wonderful guests over those years and many repeat guests that I know you will enjoy, including experts in the commercial world like we have today. Robert Kiyosaki, Bruce Norris, Sean O'Toole, Robert Campbell, Dr. Doug Duncan, Fannie Mae, lots of wonderful guests, and I just love bringing them to you, bringing their expertise and their knowledge and sharing that with you to help you make better decisions and better real estate investments. So today we have back with us Rick Knauf, who is a long time, in fact 36-year experienced expert in the commercial arena. He's been with Colliers International for 20 years. In fact, he's executive managing director of the Redwood City one in the office and the Peninsula here in the San Francisco Bay Area. And he's a graduate from Santa Clara University in finance. And we always enjoy having him back. Welcome back, Rick.
Tom, thanks very much. It's great to be here, and I appreciate the opportunity to be on with you.
Thank you. And we're broadcasting this in January of 2018. And Happy New Year to you.
Same to you.
So Rick, when you went into Santa Clara University, majored in finance, did you have the intent of getting into real estate?
No, I didn't really know what I wanted to do when I got out of college. I was, when I was in my senior year, I was finishing up, and I just started interviewing with several companies, but I didn't really have clear direction.
Okay. So what planted the seeds for real estate? And is that where you started right away, or?
Yes. So what really got me started is kind of a funny story. I was, looking at job postings at the time, and there was one that said, go into commercial real estate and make $100,000 your first year. So 36 years ago, that looked pretty good. So I decided that was worth an interview, jumped in and liked what I heard and pursued a career. Well,
I often tell people, most of my real estate friends, investors, investing in real estate became their second or third career, and not too many were smart enough to start off down that route. So whom was that with, that first job?
My first job, I went to work with a company called Asheville Burke, and they had been in business for 10 or 15 years at the time, and they were really at the top of the game at that time. But shortly thereafter, I looked around and I was one of the more experienced people in the room, and so I decided I better make a switch to a different firm. So after about 2 years, I went to work for a company, Fuller Commercial Brokerage, and then that evolved into a management position about 5 years later. And then at that point, I hit my first real market cycle down, and the company came in, closed the office, and then I was out of work for a period and went looking for another job.
So was that post 89?
That was in 89.
That was 89. Yes.
Good call.
It's for those that did not live through that. This past crash we had was pretty bad, but it certainly wasn't our first. I've been investing since the early 70s, and I'm watching cycle number 5. This last one indeed was pretty bad. However, I think there were more warning signs, and there's now those of us that have been here a while have have our antennas out a little bit more to look for them. But in '89, it's amazing. I think we did remarkably well considering how bad it was. The wall came down, so the Soviet Union fell, and all the DoD money dried up. And people don't realize in Silicon Valley here in Bay Area how much defense work there is. It's overshadowed in the headlines by the internet, famous companies and so forth. But there's an awful lot that's done here toward our defense of our country. So that ended, and we had the Japanese and Asian stock markets went south. So all of the cash that was walking up and down the streets in Cupertino to buy houses at any price dried up overnight. And we had the Loma Prieta earthquake. And all three of those events happened within 90 days. So the fact that we residential only dropped about 25% is actually, I think, shows remarkable strength of the area.
It sure does. That reminds me of at that time, the commercial market really went south. And, it took another 5 years for it to really kind of work its way back. But during that period of time, companies were still growing. You mentioned defense. Lockheed was one of the biggest employers at the time. Mm-hmm. And, the bigger companies kept rolling along.
How bad was commercial hurt during that time period, and which asset classes got hurt the least and the most? You recall? I know I didn't ask you to prepare for stats, but just from your recollection, what had the most pain, what had the least pain?
Yeah, I think what really caused a lot of the pain was, you may remember a lot of the S&L crisis. That was all part of that same period in time where many of those were closed up. They ended up the government put together the Resolution Trust Corporation, and so a lot of these assets, but were sold out of foreclosure. But the primary classes at that time that had the biggest problems, I would say, was office space. And then secondarily would be R&D, research and development space.
So a lot of that you call that in the business see-throughs, right?
That's right. There were a lot of see-throughs back then.
A lot of see-throughs. That means you could see it was so empty you could see all the way through the building. I remember when I first heard that term, it was and found out what it meant. It's like, oh, that was heavy. you having a multifam and you never have a see-through. There's somebody there, right? So right. An office you can have a see-through. That's tough. So you've been in the business for 36 years, and Colliers 20. What are some of the strongest lessons that you come away with if you're telling someone else about commercial real estate? What are some things you've learned that others could benefit from that you think are poignant?
Yeah, no, I've done some investment work myself, and I think the biggest thing, if you're looking at in commercial opportunities, it's a lot more complicated than people may think. There's, when you're buying your house, you're trying to get a loan, you're trying to, kind of line everything up. But when you get into commercial, you've got a lot more due diligence to perform when you're really analyzing a property and trying to make a good decision. Some of the things you're going to look at are the marketplace. How's the market for that kind of product? And so it really makes sense to do, a lot of homework on that to make sure that the economics make sense. You're going to be looking at title reports and what may affect the property long term. Could it be easements and restrictions? Typically in commercial, you're going to have leases involved when it's not a see-through. And so you're going to want to really make sure you understand all the details of leases and how that may affect the future value of the property.
Now when you're talking on the program now and in general, when you are using the term commercial, do you generally assume that people are thinking excluding multifam or including multifam?
That's a good point. So in commercial in general, we would look at office buildings, research and development, industrial, retail, land for development would fall under commercial. And then multifamily investments or investments of all the other product types would fall under commercial.
Right. So technically, I think a lot of people don't realize that technically multifam is commercial also, but I believe most of them think in their head that apartments are separate from the category of commercial. But it's certainly a different world, quite different between residential and non-residential commercial, isn't it?
Right, sure is.
So due diligence is especially critical. My sense is that it takes a higher skill set, or maybe there's less abundance of those that have the skill set to be able to manage or to be able to do the due diligence on a non-multifam commercial product. Would you agree?
Yeah, I would agree with that, because there's just a lot more things to look at, and typically when you're looking at a property, you're always going to come up with a new twist to it. There's going to be a new issue or a new title restriction. And then the other thing I didn't mention was, from an environmental standpoint, you're always going to want to do a phase one, which is kind of a paper search of potential environmental issues in that area or on that property. And then also, if there's issues with that, then you might do physical testing,
which is referred to as phase two.
Phase two, exactly.
Which starts to get expensive.
Very.
And if the phase one person wants to cover their rear, they always recommend phase two, right?
Yep. It's funny how that works.
Yeah, that's not the part on the report of a phase one that you want to see, right?
Yeah. That'll perk you up.
Yeah. Think it's probably somewhat important to have somebody on your team that knows how to do commercial due diligence.
Absolutely. That is a real specialty, and it's an art to a certain extent. You're going to have some properties that are very straightforward, and then most will have some twist to it, where you got to really figure out, where the potential issues are down the road and prepare for them.
Yeah, you certainly don't want to have somebody on your team that's handling that for you and is learning as they go, right?
That's right.
You want them to have already learned the lessons of hard knocks before they get to your deal.
Yeah, you're right about that one.
And it's many, lots of different areas of specialty, right? Of course, any one person, like a good broker in your team, has a lot of experience, but even with that, they often bring on others that know the areas of specialty significantly more than they do, like the phase one inspectors and the roof inspector and all of those things, right?
Right. I completely agree. And every time you get into something, you're learning something new. So the people that specialize are helpful.
All right, we have Rick Knauf with us today. He's the Executive Managing Director of Colliers International at Redwood City here on the San Francisco Bay Area. 36 years of experience, 20 years with Colliers, and he's teaching us about the world of commercial real estate. So stay with us. We'll be back here in just a moment with more on Real Estate Radio Power Investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We've got the pleasure of Rick Knauf being with us today with a lot of experience in commercial real estate. By the way, if you'd like to learn more and be able to ask a lot of questions, we're launching our first Bay Area commercial and multifam club meeting on January 25 of this January in 2018. If you're listening to this podcast after that, it's going to be a monthly meeting. Go to Baycom, BACOMM.club, and you will see when the next meetings are. They will typically be the fourth or fifth Thursday of each month. So Rick, let's talk a little bit about the different asset classes and in the commercial arena. Might as well start with multifam first and just give a little outline of that. And we maybe not too much depth on any one, but just kind of define each of these classes, if you will.
Yeah, so multifamily, is kind of what it intuitively sounds like. Is it's going to be more than one residential unit, where they would be in an attached building, and it would be anywhere from could be as small as 2 units, which would be a duplex, up, and typically multifamily is going to cover units above 5 units up to 2 or 3 or 4 or 500 units in a project.
And that's that's what we call apartment houses, and there's a lot of starter investors buy the smaller properties. Another way that people can start if they don't want to put too much money into one asset class is through syndications, where they can buy shares, or someone like Wilson Investment Properties that will buy multifams, and you can buy a share in that. But they certainly have their own uniquenesses and management approach and style.
That's right. They would be looked upon as more management intensive, because for every 800 to 1,000 feet you've got one tenant, whereas commercial properties you're going to have a lot fewer tenants in your in your office or industrial. But back to multifamily, so then you've got a lot of you got more plumbing, you've got kitchens, you've got tenants and in the residential manner, so you're going to have a lot more issues that are going to come up from a maintenance standpoint, personality standpoint, and then you've got outside maintenance issues as well.
And you got shorter term leases, so you have a lot of turnover to manage.
That's right, and the leases are going to be anywhere from a month up to a 6 or 12 months, but most cases you're probably month to month, so you've got to be ready for the turnover.
Okay, what would you say in general would be, for the non-multifam commercial, is the maybe most common or least risky by most people's perception?
I would say the least risky would be a multi-tenant industrial property. Mm-hmm. And I say that because you're going to have smaller units, and the vacancy rates in industrial properties are lower in general. Rates seem to be a little bit more stable. And when there's turnover in those units, you don't have a lot in the way of tenant improvements. You might have a small office space as part of a large, with a warehouse behind it. But as far as improving it, you're just going to work on your office space with a paint job and maybe just fix things up a little bit.
And how about length of leases? They tend to be pretty long, don't they?
Yeah, so the industrial leases are probably going to be in the 3 to 5 year range, depending on what markets you're in. And then you might have something up longer than that, but in the multi-tenant, you're probably in the 3 to 5 year range. Mm-hmm.
But you very unlikely have overnight skips like you do in multifam, right?
That's right. That's right. And when people look at potential tenants, they're going to look at some financials statements more than you would probably for a residential unit, and track history on the business.
And would you say in multi-tenant, the market that they're in is pretty important?
Yeah, really important. Mm-hmm. Yeah, and is there what's the past history been for that kind of a product, and the absorption and needs for it versus going forward? Is it going to remain in a good product to own in the future?
Yep. So you might not necessarily need a high traffic count like you would for retail, but you certainly want a strong economy that when it turns over, you've got plenty of other potential prospects tenants to put in there.
Right. Yeah. When the market, the biggest challenge, when the market's good, it's easy. When the market gets a little soft, you've got to be aware.
Stay with us, and when we come back, we'll talk about industrial single tenant and go on to the other asset classes with Rick Knauf, the Executive Managing Director of Colliers International. Stay with us on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We have Rick Knauf with us today. We're talking about commercial real estate. And if you would like to hear more of the kind of information you're getting today, on a monthly basis, go to baycom.club, BACOMM, Bay Area Commercial and Multifam Club, and see when the next meetings are. They are in Great America Parkway in Santa Clara, monthly, the fourth or fifth Thursday of each month. So Rick, let's work our way along the other asset classes. We talked about industrial multi-tenant, before that multifam. Talk about industrial single-tenant and how on the surface industrial to most people might seem about the same, but how different single-tenant is than multi-tenant.
Okay, now great question, Tom. So when you look at a single-tenant industrial building versus a multi-tenant, what comes down to is that the strength of the tenant becomes very important for the longevity of their occupancy and how valuable their occupancy is going to be. So what you do is you want to look at the history of the business, as well as their current financial statements in probably the last couple of years, and projections for what they may be doing in the future, because the value in the building for a long-term lease and for a single tenant is really the value of the tenant, because they're going to be paying your rent.
Mm-hmm. And a single tenant industrial, I feel, is generally gives a higher return than, say, a single tenant national brand retail, because the perception is a Walgreens will be around forever and the name is known, right? Whereas if you get an industrial tenant that maybe has been around longer than Walgreens, is financially stronger, but it's not as known a name, so you'll get higher returns, right?
That's right. And when you bring up retail or a drugstore, and those are much more prominent in the market, and so they're much more popular. I think most buyers can relate to drugstores, fast food restaurants, restaurants. And so, yes, they're going to have long-term leases, and they know about them. A lot of times they are stronger, but you will get a lower return.
Mm-hmm. And I sense that often perceptions are not necessarily the same as the reality and the risks that people are taking on. If they know a name, they have the sense that, well, then if I know it, it must be good, which isn't always the case. Right?
That's right. There's been very many restaurants in probably the last 4 or 5 years that are well known, and they are, second nature for people to go there. Chevy's was one of them, and there are several others, but they financially did not have the wherewithal and a good business plan to really stick around. Mm-hmm. So those have been less desirable investments, and people that bought them had problems because they had to get them released.
And when you have a single-tenant industrial, would you say that the metropolitan area and location isn't as important as long as they've got a good labor force and distribution to get their product out?
I agree, and you don't need to have necessarily the exposure or the freeway visibility, because it's a kind of a back street facility, and so you can have it different types of places.
Yeah, Wilson Investment Properties has done a number of these single tenant and some multi-tenant. But we really like the single tenant when it has a great track record. But boy, we also hire on our team a high level financial person that can really do a deep dive into seeing what their balance sheet and history really is and what their personal assets are. So we'll be back with Rick Knauf here in a moment, and we'll talk about office and retail, and maybe touch on a couple others as well. So stay with us here on Real Estate Radio Power Investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Always a treat to have Rick Knauf back with us in the studio here in Wilson Investment Properties headquarters in Silicon Valley. Rick brings with us with him 36 years of experience in commercial real estate, 20 years with Colliers, and he is the executive managing director of Colliers International, Redwood City. And we're talking about different asset classes. And if you like this kind of information, want to learn more about different kinds of commercial, multifam, and syndication information, Wilson Investment Properties is starting a new club called BAYCOM, Bay Area Commercial and Multifam. Go to baycom.club, and you can see when the next meetings are. They're typically the fourth Thursday of each month on Great America Parkway in Santa Clara. So we're excited about that, and launch the first one on January 25 of this month of January, as this broadcast is in 2018. Rick, let's move on to the other two major classes. Let's talk about office.
Okay, so the office buildings are, traditionally provide a home for the service industries. In Silicon Valley, that has gone from being primarily banks, law firms, accountants, to including many tech companies, where they used to be more probably they used to have their engineering in what we would call an R&D building, which was partial office, partial industrial, and now they've really evolved into being primarily an office space with technology. So we've seen a lot of technology companies expand in the Silicon Valley area. It's been very, very active in the last 5 or 6 years, really driven at the forefront by the larger companies being Google, Apple, and Facebook.
So startup companies, I presume, would still do kind of semi-industrial, where they'd have their office and maybe some of their R&D in the same space, and as they get bigger, then they evolve to split those up?
Yes, yeah. I would say there's probably equal numbers of startups doing in like a split type space versus just starting into an office space with primarily tech engineers and software people.
And I guess what's happened as our Silicon Valley has evolved, we tend to be more soft oriented rather than hardware, right? So they don't need to have a space to go build stuff. It's more conceptual, or think tanks, or software.
Absolutely. A lot of the manufacturing and some of the more hardware-driven industries have moved into lesser expensive areas. Could be offshore in China, Mexico, and some other places that are less expensive to manufacture products.
How much would you say office swings up and down in market cycles?
Well, that's a good question. Significantly. So since 2010, which is when this recent market was kind of at the bottom, since then, between office, industrial, and R&D, the rents have gone up between 70 and 100%.
Wow!
In the last 7 years. And so it's
And
significant.
are those numbers for Silicon Valley or Bay Area?
Yeah, so Silicon Valley, Santa Clara County and San Mateo County.
And I don't have numbers off the tip of my tongue, but I believe it's similar in other powerhouse economic centers like Dallas and Houston. They're
right.
Just amazing.
If you were to include San Francisco, it's probably more than that even.
Okay. So office is a little riskier when things are good and it's occupied. It can really pump the cash, right? And when it goes section up goes dark, takes a little while to find a replacement.
Yeah. No, it tends to get very soft when the market goes down or when kind of stalls out. The most expensive part is you've got time to release tenant improvements, and then you've got rents are falling. So between those three things, it takes quite a bit to hang in there.
In the couple minutes we got left here, let's talk about retail. So for a while, it was everybody's favorite asset class to hate, a la Amazon and so forth. And then lo and behold, when everybody thought brick and mortar is going to be scraped off the face of the earth, Amazon buys Whole Foods for $13.7 billion. And the other night I was walking after dinner down Santana Row in San Jose, and I walk across a building that is just swamped with people at 9, 10 at night. And I look up, it says Amazon Books. And the people were lined up with piles of physical books in their arms to buy them. So And the best I can tell, you still can't get your dog groomed on the internet, and you can't drink a beer on the internet, and right. So talk about the highs and the lows of different kinds of retail, and what your current thoughts are about it.
Yeah, no, I think retail is definitely not going away, but it is evolved with Amazon. All the sales online and other companies online. It's changed the industry, and I think what the retail centers or malls are and where they are makes a huge difference on the future success of those. You mentioned Santana Row, one of the finest retail malls on the West Coast, probably. Mm-hmm. And then you've got on the other side of it, you've got many neighborhood little retail centers, and I think those seem to be doing fine. But I think
because they're really service centers, right? They're not kind of things that compete with commodity products online.
Right. So they're gonna include cleaners, in the like, mm-hmm. in certain things like that.
Hair salons and dance
exactly.
studios and
Soul Cycle and
yep.
some things
mm-hmm.
like that.
Yep.
But retail, I think, from a return standpoint, has been pretty consistent. During the last cycle since 2010, it's been very consistent from a vacancy standpoint. Rents have increased. And even through the last downturn means 07 or 08, it was probably more consistent than any other product type. So it really did very well.
And I think that would surprise a lot of people to find that. But you got to adjust with the marketplace, right? So a more emphasis on are they service oriented, right, versus a online commodity competition.
Right, exactly.
Okay, we'll come back with a wrap up here in just a second with Rick Knauf, the Executive Managing Director at Colliers International, Redwood City, and we're going to just summarize what he walked through and tell you again about where you can go to get more of this kind of information. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
So, Rick, I know you've been a personal investor as well as being in the business of servicing others who are buyers and sellers in the commercial marketplace. But I know when you've bought products in other locations, you even though you know a lot, I know you go and find experts that know things about that particular market that you don't know, correct?
Yeah, Tom, that's a great point because you need to kind of know what you do know and what you don't know. And we have gone outside this market, but it's really critical to find the experts in the team locally so you can do the right due diligence and feasibility. And then once you do buy a property, you've got the right team to maintain it, make sure it's managed and leased up and handle issues.
Who are some of the key professionals on a team that someone should have if they're entering this marketplace or entering this commercial products?
Yeah, I think to have a good property manager is kind of your staple. You really need that everything else will evolve around that, but on a day-to-day basis, you're going to need to have a strong property manager who is going to be proactive and not reactive. And then in addition to that, you want to have a good leasing team and a good asset manager.
And when you're looking for a product and doing due diligence, whom do you need on your team?
You're going to want to go out and find a good environmental consultant, a good title company, somebody that's going to analyze your leases and really go out and physically inspect a property to make sure you understand where the issues are or not.
And you tend to want to have an attorney, and you want someone who can financially do a deep dive on the tenants, especially if it's a single tenant, right?
Yes, yeah, those are good. Those are good additions, absolutely.
Good title company and a great broker.
That's right.
That broker is what a lot of people don't realize is how how many deals a broker or a syndicator that has a brokerage goes through to look at and do diligence on that they has enough flags and hair. They say, nope, I'm more interested in your long-term business, and I want to tell you that I think you should pass on this one and go to the next one. Right?
That's right. That's really the broker's job, is to really do a good job advising and consulting and be part of the team.
If you'd like to hear more of Rick, come on January 25 to our launch of our Bay Area Commercial and Multifam Club, baycom.club. That will be on January 25 of 2018. Or go on and see when the next and future ones are, which will be monthly, covering strictly commercial, multifam, and syndications. Most RIAs in the country focus on houses. We still like houses, but we like commercial and multifam even better. So also go to TomWilsonProperties.com for a lot of education information. Go on there for all the podcasts that we have with famous personalities and experts in their field, such as Bruce Norris, Robert Kiyosaki, Dr. Doug Duncan, and Sean O'Toole, and Robert Campbell, and so forth. So it's been nice having you with us. TomWilsonProperties.com. Sign up for our weekly newsletter that will give you access to a lot of our products. And Rick, it's always a pleasure having you on, and we look forward to having you as our keynote speaker there on January 25.
Tom, thanks for the opportunity to be on with you today.
Thank you. And remember, the only thing that matters is what you do next.